One of the most universal and widespread technical indicators is known as moving averages. They are used in most trading systems that incorporate trend following indicators because they're extremely easy to plot. Of course, although we don't have to plot anything ourselves, we've got a computer for the humdrum work. It's a good idea to understand how they are calculated because we will then be able to use them more effectively. So, the simple moving average, or SMA for short. Let's cast our minds back to our school days and those long arithmetic lessons. No doubt you remember how to calculate the average of a number of values. Take a look at the formula for the SMA. N is a variable and is the number of time periods in the moving average. And C, for close, is an old friend of ours, the closing price. Although other prices can be averaged, for example, the high, the low, or the midpoint between the high and the low, more often than not it's the closing price that is averaged. So we can see that SMA is simple and that it's an average, but what about the moving? Let's take 5 bars or candlesticks, whichever you prefer, but we'll take 5 bars for the sake of simplicity. With these 5 consecutive bars, we can calculate the first value of our simple moving average. At the beginning of the new day, or hour, or maybe week, a new closing price will be added to our formula, and the last one will drop off at the same time. We've started moving along the price chart. We have selected a variable of 5. It may be 5 days, 5 hours, or 5 weeks, whatever. It's a relatively small period. The moving average dogs the price chart pretty closely. If we increase the period to 10, for example, then the moving average will look smoother and slower. What I mean is that it will react more slowly and smoothly than the price chart. Compare it with a 5-period moving average. If you're using SMA as a trend indicator, then the slower SMA is sounder and more reliable. In previous films, we examined support and resistance in the form of straight lines. What we have here are curvilinear support and resistance made up of moving averages. We can use them as trend indicators. When price is higher than the simple moving average, it's an uptrend, and when price is lower than the moving average, it's a downtrend. This uses the commonly cited major drawback of moving averages, that they lag behind the price chart, to our advantage. But because this average is called simple, it stands to reason there are more complicated averages. Well, first off, my friends, let's remind ourselves that the goal of technical analysis is to forecast future price behavior on the basis of past price behavior. Have you ever heard of a weather forecast based on the statistical data of the amount of snow that fell 10 years ago? It's not likely. Of course, research data should take the past into consideration, but it's the current situation that lies at the heart of any forecast. What I mean is, what happened today is more important, it carries more weight than what happened yesterday, and yesterday's events are more important, they have more weight than those of a year ago. And now let's go back to the formula of the 10-day simple moving average. There's a factor of 1/10 before each closing price, and it's called a weight. In a simple moving average, all the weights are the same, but we want today's price to have the most weight, yesterday's to be a little lighter, the day before yesterday's price to be lighter still, and so on. Let's call this a weighted moving average, or WMA. Naturally, it incorporates the variable of n, and in our case, n equals 10. So what do? To start with, we change the factors in our formula to 10, 9, 8, 7 and so on down to 1. The further the price is from today, the less weight it has. We add the finishing touches to this formula by dividing it by the sum of weighting factors. That's it. Now let's see what the formula generates. It's definitely different. Please note that this new moving average has the same number of time periods, 10, but it's faster and more sensitive to fluctuations in price. Although the formula is simple, it would be a real chore to do the calculations manually. Fortunately, we have Rumus to hand, our technical analysis program, and with its help, we just have to select the time period we want in the parameters window. Let me just remind you once more that the greater the value of n is, the slower the moving average is, regardless of what type it is. The introduction to technical analysis of weighted moving averages led to the appearance of a whole raft of ways of averaging data. So, which moving averages are currently in vogue? Well, along with simple moving average, they are exponential moving average, or EMA. Let's compare it to a simple moving average and weighted moving average using the same time parameter. We can see that exponential moving average is faster than simple but more smooth than weighted. In addition to simple and exponential moving averages, the variable moving average, or VAR, is quite widely used. As we can see, this moving average is slower than simple moving average. You could well be wondering what it's for. Well, as you'll remember, moving averages were designed as trend indicators. When the price is above the moving average, we have an uptrend, and when the price is below the average, it's a downtrend. But what about when there is no overriding trend? I mean, when we are in a trading range. Watch how the variable moving average fluctuates. Unlike its friends, it's almost flat. Trust me on this one when I say this is a very interesting feature. Now, the way that moving averages with different time lengths interrelate with each other on a chart can be a fine trend indicator. In fact, if last week's averages were greater than last month's, we've got an uptrend on our hands. In the same vein, there are trading systems based on how and when two moving averages cross. Look at the chart. Let's examine what is referred to as double averages. For simplicity's sake, we'll use 5-day and 10-day moving averages. When the faster line crosses above the slower line, we have a signal to buy. Conversely, if the faster line crosses below, it's time to sell. These buy and sell signals are marked on the chart. It'd be very useful if we could predict the points where the averages cross. It'd be unrealistic to expect to predict when, but it's quite possible to predict the zone. Let's shift the 5-day MA 5 days forward, and this is what it looks like. Now let's do a small conjuring trick. Notice where the averages cross. This isn't magic, it's simple mathematics. A word of caution: with different time periods we need to use different averages and different shifts forward. Traders make use of this feature when developing their trading systems. For example, Bill Williams developed the indicator he called the alligator. Take a look at this beast. The jaws of the alligator open when a trend begins. The three lines you can see are exponential moving averages shifted forward. Look how this reptile protects our profits with its open mouth. Actually, it only does so while the trend lasts. And here are Williams' formulas for the calculation of these EMAs. The closing price is not used. Instead, we use half of the sum of H and L. That's the midpoint on the bar. And when the trend ends, the jaws close. The alligator is also an excellent example of a trend indicator. And then there are clouds. But I think I'm overloading things here, so we'll cover clouds in a different film. In conclusion, I'd like to underline that we will need just 3 types of moving averages in our work. These are the simple moving average, SMA, exponential moving average, EMA, which is faster, and variable moving average, VAR, which is slower. You'll notice that there is no weighted moving average in this list. Let me explain why this is so. Extensive research confirms that simple and exponential moving averages in different trading systems consistently perform better than weighted moving averages. Variable moving averages are the most effective at identifying trading ranges. All of these averages have just one parameter, n, the number of time periods in the moving average. Up to now, we've examined combinations of moving averages. We've already seen that an MA with a shorter period is faster than an average of the same type with a longer period. We know that how the averages interrelate with each other is a trend indicator. If the faster line is above the slower line, it's an uptrend, and if it's lower, then it's a downtrend. But what should we do if the trend reverses or flattens into a trading range? To mark trend zones and to differentiate them from reversal points, we use an indicator which is based on the difference between 2 moving averages. It's called the price oscillator, where MAN1 is the faster moving average and MAN2 is the slower one. It stands to reason that N1 is less than N2, and this is what the indicator looks like. The price oscillator has a value of 0 at the points where the 2 moving averages cross. If the fast line is higher than the slow line, the oscillator has a value above 0, and if the fast line is lower than the slow line, the oscillator value is less than 0. Let's identify the areas where this indicator is rising and is above 0 and falling and less than 0 and shade them. We can confidently claim that in these zones there is a trend and it's either rising or falling. And what's going on in the unshaded areas? We do not know. The trend has either reversed here or it's paused. In other words, all we definitely know is that the previous trend has gone, and it's not important how long for. The previous trend has gone, and that's all we need to know. Note please that I've said nothing about the type of moving averages to use. They should either be simple or exponential moving averages. The choice is yours, and that's why we've written them just as MA. I'd now like to discuss the selection of the appropriate time periods N1 and N2. Let me run through a few examples. Here is a daily chart of Japanese yen. The values of N1 and N2 have already been selected. They are 7 for the fast line and 65 for the slow line. But why? 65 is 65 trading days, that's 3 months, a quarter. It's a natural cycle. 7 is approximately 10% of 65, and it has been selected experimentally. The profit to be made using this simple price oscillator has been calculated on the basis of closing prices displayed in the green areas. At first sight it looks pretty tasty. But look at the red areas. There will be no earning opportunity and you could even suffer losses. To deal with this problem, traders employ a number of indicators, RAVI, MACD and RSI simultaneously. We'll move on to speak about them soon. Take a look at the hourly chart for the euro that's now in front of you. Now the time periods for the price oscillator are 12 and 72. 72 hours is 3 days. 12 is 12 hours or half a day. Although these figures have been selected experimentally, the slow-moving average is a natural cycle. Once again, the shaded parts of the chart are areas where in the worst possible scenario we will fail to make a profit, but in the best possible scenario we will make money. The value of the yield corresponds to the number of time periods. The fewer the time periods, the smaller the value of the possible profit. Never forget that. Variously described as an inventor, a scientist and a respected trading systems developer, Tushar Chand decided to take the potential of the price oscillator and develop it into a much more reliable trend indicator. He came up with RAVI. This stands for Range Action Verification Indicator. It looks very similar to price oscillator, but it is in fact rather different. For daily charts, RAVI looks like this. The difference between a 7-day moving average and a 65-day moving average over the 65-day moving average, then multiplying the whole thing by 100. First thing to note is that unlike the price oscillator, it's calculated as a percentage and not in points. Another difference is that Chand suggested using signal lines for his indicator. They are drawn at a level plus minus 0.3 to 1% for the Forex market. We have an uptrend situation when RAVI is above the upper signal line and rising. Conversely, it's a bear market if RAVI is below the lower signal line and falling. Here are these zones. A further difference to price oscillator is that with RAVI there is a zone between the two signal lines. It's the trading range zone. If RAVI doesn't leave this zone between plus 1% and minus 1%, we view the market as trendless. Once again, please note that we chose a 65-day MA and a 7-day MA. We have the natural cycle of 65 days, 3 months, it's a quarter for the slow line, and the fast line, a 7-day MA, is approximately 10% of 65. And here is an example of RAVI at work on a daily chart. Here's a daily euro chart. We've decided to set our signal lines at levels of 1%. If we designed our trading system based only on the RAVI trend indicator, we would get buy currency signals and exit signals within the green zone. In the red and white areas, RAVI provides information on reversal, trend slowdown, or a sideways market. That is, RAVI doesn't generate trading signals by itself for these intervals. Still, if we had used only RAVI signals for the period of time from April 2002 until May 2003, we would have got over 2,500 points profit. However, we should note that we only traded in the direction of the primary long-term trend for the period. Do you remember what that is? And of course, we had a little bit of luck. But fortune favours the brave, and the roots of bravery are in knowledge. When we're working on hourly charts, we use time periods of 12 and 72, or 24 and 120. 120 hours, that's 5 trading days. It's a week. 72 hours gives us 3 days. The key natural cycles here are the trading day and the trading week. And here's an example of Ravi at work on an hourly chart. Take a look at this hourly chart for the euro. We've selected the parameters of Ravi as 12 and 72. Signal lines are drawn at levels plus 0.3 and minus 0.3. Zone A is an easily recognizable trading range. The indicator leaves the sideways market and gives the signal to sell at 0.1. We get the signal to get out of the market and close our position at 0.2. That would have earned us 90 points. Zone B is a period of downtrend in which we can go bearish and turn a profit. In what follows, Zone C, D, E and F demonstrate successful and not so successful market entry and exit points. In my opinion, one advantage of Ravi is its ability to identify trading ranges, which we have marked in red. So what do you think happens if you change the time parameters of Ravi a little? Let's try time periods of 24 and 120 for the same chart. That's 1 day 24 and 1 week 120. Nothing has changed in Zone A. It's a trading range, a flat. We get the sell signal at the same point 1, but we get a signal to exit much later at 0.3. A profit of 290 points. But let's not get overconfident about Ravi. It's not 100% foolproof. A false buy signal was generated at 0.4 and the stop loss was executed. What have we learned here? Well, firstly, we pay for our mistakes, so set your stop losses. And secondly, we should not rely on one indicator. We should employ a number of indicators and combine these with chart analysis. All the trend indicators we've reviewed so far are simple to calculate and are quite visual, but there are more complex indicators. Here's one, the average directional movement system, more commonly known as ADX. Here is this system. It has just one time period parameter. The value of this parameter should be somewhere between 10 and 20 periods. To be more precise, let's say between 14 and 17 periods. Experiment a little and find what suits. The indicator consists of 3 lines. All 3 lines are measured on the same scale from 0 to 100. The main line is ADX. If it rises, it means that there's a trend on the market, and if it falls, it means that the existing trend has ended, at least for a while. But ADX cannot tell us whether the trend is an uptrend or a downtrend. And that's what the other 2 lines are for. The red line is called plus DI and the green one is minus DI. If plus DI is above minus DI and ADX is rising, then we've got ourselves an uptrend. If minus DI is above plus DI and ADX is rising, then the trend is down. Now, if plus DI is above minus DI but ADX is falling, or if minus DI is above plus DI and ADX is falling, it means that the trend has slowed down, stopped, or even reversed. This indicator has a trait that you should be aware of. ADX will continue to fall at the beginning of even a powerful trend. This is because of the way ADX is formulated. Observe. Plus DI is above minus DI. It's falling. So is the price. Minus DI, on the other hand, is rising and ADX is falling. ADX will continue to fall until minus DI crosses plus DI above. Now ADX turns up too, and the downtrend is registered by the system in the standard manner, but this could cost you. Plus DI and minus DI cross around 20 to 22. ADX also identifies weak trends and trading ranges. ADX signals these by falling below 20 and gives an even more reliable signal if it falls below plus DI and minus DI. Directional movement system works well on daily and weekly charts, that is where one candlestick represents a day or a week, but it works very badly on hourly charts. So, shall we move on? I'd now like to discuss Bollinger Bands. This is an indicator envelope. We select a moving average and the price range is charted around this MA on the basis of a set of rules. So what are these rules? The first rule is to select a moving average with a time parameter n. To be more precise, if we're working with hourly charts, then n should equal 24. That's 24 hours. And if we're working in a daily time frame, then we'll take n to equal 22. That's a month. These are the natural cycles. The second rule defines the width, or the height, of the range D. By adding and subtracting D from the value of the moving average, we get the upper and lower lines of the Bollinger Band. The value of D is determined by the parameter S, which we select ourselves. The range of permitted values for S lies between 0.5 and 3. But before we go any further, let me explain sigma, the symbol for standard deviation. The sigma value is a sign of the volatility of market prices. Look, for any time period that you select, let's say 24 hourly bars, we can draw a straight line in such a way that the sum of the deviations of the closing prices from this line is the minimum possible. As this line moves along the chart, its incline will change, as will the minimum sum of its deviations. But most importantly, the incline of this line, and it's called linear regression, and the minimum sum of deviations have a precise value that can be accurately calculated using mathematical formulas on a computer. The minimum sum of the deviations of the close price is the basis of the calculation of sigma, the standard deviation. And the standard deviation is the statistical measurement of price volatility for the period n. Sigma is a factor of the width of the range in the Bollinger range. So let's get back to S. D is the width of the range and is equal to S multiplied by sigma. To calculate D, we need to know how many bars our sigma is for and what value of S we've selected. Sigma is calculated for the same period n, which we set for the moving average. If we take S to equal 0.5, then D will look like this. And if we take S as 2.5, then D will equal 2.5 multiplied by sigma, and the Bollinger range will look like this. So, how can we profit from this envelope indicator? Let's work on a daily chart first with N set at 22 and S at 0.6. If the price breaks the upper line, we get a signal to buy, like this. Can you see the arrow? If the price breaks the lower line, we get a signal to sell. See what it looks like. If the prices are between the upper and lower lines, no trading signals occur. There's some turbulence, and it's a trading range, a sideways movement. The value of S used to determine the exit point from a trading range varies from 0.5 to 0.8. For hourly charts, this approach is not really appropriate because we get too many false signals. Have a look at the example for Japanese yen. Let's play around with parameter S. Here S equals 0.5. Here 0.6. And this one 0.8. Draw your own conclusions. And now let's examine the other working approach for Bollinger Bands. Here are our hourly candlesticks once again. We'll make N equal to 24 and S is at 2.5. The Bollinger range has widened sharply. Our trading signals will also be different. When the price makes an upper line breakout and then drops down again, it's a sell signal. And vice versa. When the price breaks the lower line and comes back into the Bollinger range, a buy signal occurs. Let's check through a few examples. Here is the Swiss franc. Note that here the moving average itself sets the borders either as support or as resistance. And here are Bollinger Bands on daily candlesticks for the British pound. N here equals 22 and S is 2.5. We've looked at a few successful applications of the trend indicator Bollinger Bands. But of course, it's not always so successful, especially for beginners. I'd like to call these scenarios traps for unwary beginners. This is a daily chart of the Swiss franc. The price has breached the lower band and comes back into the range, but then it continues its fall. It's a false buy signal. And this is an hourly euro chart. The price has broken the upper band, but then comes back into the range and then continues on its way up. It's a false signal to sell. Of course, Bollinger Bands have some defining quirks. If there are new highs after the return of price from an upper band breakout, there is a strong signal for a surge in the uptrend. Therein lies the trap. I'd like to conclude this section by saying that Bollinger Bands were designed to be used with other indicators. We're going to go over them soon. Also, and I'll make no apologies for repeating this, don't forget to set your stop loss. If you've got the cover of a stop loss, then your misjudgments will not lead to catastrophe. Up to now, we've examined different trend indicators. These will help you determine the state of the market. Is it trending up, trending down, or in a trading range? But at the same time, you as a trader will be more interested in the points of trend reversal. Now let's say the trend is rising. When price touches the support line, it's good time to buy. And when price nears the channel line, it's a good time for profit taking. But we also know that charts in reality are not always pristine and perfect. Price sometimes crosses the lines and sometimes it doesn't reach them. Oscillators have been developed by market analysts to determine the optimum time to enter and exit the market. These oscillators measure the speed of price movement rather than price level to generate signals. The granddaddy of all oscillators is momentum. This oscillator considers the difference between closing prices for a certain period. Momentum is the difference between today's close and the close n days ago. As the fall in price slows down, the difference in closing prices decreases and momentum tends towards zero. But because closing prices of each separate hour or day are relatively random values, momentum is rather volatile. And that makes it of little use in price analysis and of even less use in sound forecasting. To eliminate the disadvantages of this oscillator, it's necessary to smooth the volatility and set strict borders on fluctuations. With this in mind, J. Wells Wilder developed a new oscillator. It's called Relative Strength Index, or simply RSI. We're going to examine its basic features now. It has just one time parameter, n. We're interested in the behaviour of closing price for the period n. If the closing price is higher than the previous one, then the value is blue. And if it's lower than the previous, the value is red. So the ratio of the sums of positive and negative variations u and d for the period n, expressed as a percentage, is the RSI. Take a look at RSI. Its minimal value equals 0 and its maximum is 100. Its inventor suggested using a time period of 14 for daily charts. It should be noted that RSI almost never reaches its extreme values of 0 or 100 if n is equal to or greater than 14. To get a better understanding of this oscillator, keep your eyes on the level 50. If RSI is greater than 50, there are more positive closing price changes than negative, and today's closing price is definitely higher than closing price 14 days ago. Vice versa, if RSI is less than 50, it means that today's closing price is less than 14 days ago. When RSI equals 50, today's closing price equals the closing price of 14 days ago, just like momentum at 0. Well, we've already studied how to identify price direction, and we know that relative strength index was not developed for trend following. Our goal, and RSI's too, is to identify optimum entry and exit points. RSI fluctuates between 0 and 100, and we draw two horizontal lines within this range at levels of 30 and 70. When the indicator is above 70, it's gone into the overbought zone. The market is overbought. When RSI falls lower than 30, it's moved into the oversold zone. The market is oversold. These zones will look pretty in pink. The sell signal is generated when the oscillator leaves the overbought zone from the top down, and it's wise to buy when RSI gets out of the oversold zone from the bottom up. Notice the arrows. These signals are also pretty sound in a trading range or when a trend is finished. The overbought and oversold zones. It gets really interesting when a chart enters the overbought zone and buying continues for 2 weeks, a month, and then would you credit it, a year? Look at this example comparing a trend with the change of relative strength index. The price will rise till demand is higher than supply. The terms overbought and oversold are misleading. RSI will carry on trying to reach 100 for as long as the price keeps rising, or it can continue striving for zero while the price is falling. What should we do? Sit on the fence? Hold all trades? No way. Believe me, RSI is an extremely useful indicator. Look at this rising red line. It's a support line, but it's not for price. It's for the RSI oscillator. Every time that the indicator tests and recoils from this support is a good opportunity to go long. But the trees can't reach the sky, and trends, like all good things, must come to an end. So what happens at the top of a trend? Very often when RSI breaks through the support line, it behaves like price. It retests the line from below and then heads off down together with the price chart. On a bear market, our oscillator behaves in a similar fashion. Here we have a daily chart for the Swiss franc. Sell, sell, buy. The RSI oscillator has one more wonderful feature. Wilder called it the failure swing. You'll remember this term from your previous study of chart analysis. Nowadays it goes by a different name, divergence, or a discrepancy. This is what divergence looks like on a bull trend. The last price high is higher than the previous one, and the last oscillator high is lower than the one before. Let's draw two lines, one up line and one down line. There you go, that's your divergence. On a falling market we draw two lines too, but now the down line is on the price chart, that is, the last low is lower than the previous one, and the indicator will have an up line. Divergence strikes again. A divergence is a very strong signal of a coming market reversal. Never ever ignore it. Although divergences come in different shapes and sizes, all of them are instantly recognizable. Let's check them out. A double top has formed on the daily chart of the euro, and RSI indicates two falling highs. It's a divergence and it's a strong one. Here we can see a double bottom on the price chart. RSI has formed two troughs and the last one is higher than the previous. Divergence again. When a divergence forms, what we really like is when the last indicator high is below the signal line of 70, that is outside the overbought zone, and also that the last trough of RSI is above the 30 line outside of the oversold zone, like this. How should we select the time parameter N for the RSI oscillator on daily charts? The developer suggested a value of 14. Other researchers apply a value of 9. Well, let's use a range of N between 9 and 14. We advise setting N at not less than 7 and not greater than 11 for hourly charts. Make a note of these values. Some traders are not satisfied with the choppy appearance of RSI and they smooth the oscillator's line. The usual way of smoothing is to average the indicator's value with a simple or exponential moving average. This is an option in RSI's properties windows in our technical analysis software, Rumus. Please note that the smoothing of the indicator reduces the amplitude of its fluctuations. Because of this, we can change the level of the signal lines to match the averaging value. Here, smoothing is strong, and the overbought and the oversold zones have been widened to 60 and 40 accordingly. RSI is most effective when it's used in conjunction with a trend indicator and chart analysis to identify resistance and support levels and lines. We'll continue looking at the overbought and oversold zones in this examination of a slightly more complex oscillator which also incorporates them in its search for reversal. It was developed many years ago by George Lane. Nevertheless, it's been making something of a comeback recently because of modern technology. What's 20 years between friends? The principle of the stochastic oscillator is based on the tendency that, with a general price rise, closing prices as a rule converge to the upper boundary of the price range. And vice versa, when there is a downtrend on the market, they converge to the lower boundary. Several curves are used in this oscillator. The main curve is called percentage K. Stochastic determines the level of the latest closing price relative to a price range for a certain period of time. This is the indicator's first value, N1. The most widespread period used for this curve is 5 days, or hours or weeks. The formula of this curve is strikingly simple. Here it is. It helps determine the position of the last closing price in relation to the lowest price L5 and the highest price H5 of the range for a selected period of time. We've chosen 5 days. The K-curve is very sensitive to price change and it spends a lot of its time banging its head on the floor or the ceiling. Which is why we don't feature it in rumours. But if we average it, for example over 3 days, we get a slower curve. 3 days is the second oscillator's time period, N2. We'll call the new curve a slow percentage K line, although it'll be the fastest one on our stochastic chart. And here it is. And after averaging or smoothing the new percentage K line for 3 more days, we get a percentage D line, and the third and last time period, N3. We'll chart percentage D as a dotted line on the chart. And that's it. Plotted it at last. So what have we got? 2 lines, a slow percentage K and percentage D. In addition to this, we have 3 time values. N1, 5 is the customary value, and N2 and N3, they're the smoothing periods. We've set them both at 3. And you can play around with them. Your computer will help you again. The K and D curves fluctuate between 0 and 100 on the vertical scale. The overbought and oversold zone should be set with signal lines drawn at 30 and 70. And how does this oscillator generate trading signals? At first sight, in the same way as the previous indicator, RSI. The first type of signal appears when the K curve leaves the critical zone. If we've set the overbought level of 70, then when the K line crosses the level from above, it's a signal to sell. If the K curve crosses the oversold level of 30, it's a signal to buy. The second type of stochastic trading signal is when K and D cross. Let's see what they generate. Whoa, maybe there are too many signals. We shouldn't jump to conclusions. Well, to start with, let's go back to the idea of divergence. Divergence in stochastic is a discrepancy between the price chart and line D. There are examples of bullish and bearish divergences given on these charts. They look similar to those of the previous oscillator RSI. When a divergence of line D in the price chart occurs, the crossing of lines K and D gives a most significant trading signal to buy or sell. Let's use other time parameters to examine some special features of stochastic. 14, 5 and 3. These values were put forward by technical analyst Thomas Wirwitz. A moment ago, I said that divergence on stochastic looks similar to divergence on RSI. Similar, but not the same. Do you remember the principle that stochastic is based on? Closing prices come closer to the upper boundary of the range when the trend is bullish, and to the lower line when the trend is bearish. Which is why with a strong uptrend on the market, the stochastic entry into the overbought zone looks very special. Do you see what I mean? It seems that line D is endlessly moving from 70 towards 100. But that can't happen. The market needs to have a breathing space and consolidate before reaching its top. And at that moment, line D leaves the upper zone and starts falling. This signal is usually ignored. D returns to the overbought zone and can form a divergence, and the crossover of K and D provides an excellent shorting opportunity. Great help with filtering these signals can be had from the price support and channel line and from the alligator, both of which we discussed earlier. Take a look. Just like we did with RSI, a support line is drawn on the stochastic chart. After breakout, support becomes a resistance line and causes a divergence. And now let's examine an example of a bearish divergence. We have a typical entrance into the critical zone. The indicator then leaves the zone briefly, and there's the divergence and the buy signal. Let's just take a look at the lines that form the borders of the price channel. The combination of stochastic signals and chart analysis makes the trader's life easier. So what typical characteristics does stochastic have? This pattern has its own name, the hook. Usually it occurs around level 50, and often it happens at the very beginning of a strong trend. We can only identify a hook or anticipate its appearance by watching price activity within the price channel. It may occur after a breakout on the support line, or, as we can see here, a breakout on resistance at the beginning of the uptrend. It says a lot that Lane, the inventor of stochastic, recommended using it for studying long-term price dynamics, and he suggested plotting stochastic for weekly charts and taking the readings into consideration when looking for trading opportunities on daily charts. Modern technology allows traders to work on hourly charts. Having plotted an hourly stochastic, let's try to filter its trading signals with the help of stochastic plotted on daily charts. Here's how it looks. When the daily stochastic is rising on the hourly oscillator chart, we can use only buy signals. We'll buy when the K line comes out of the oversold zone and close the position when line K leaves the overbought zone. Careful now, here the indicator left the oversold zone, but it didn't reach the overbought zone and it fell back. Let's call this situation an undermove and close the position as soon as line K falls below 30. Hold it, there's another undermove here, but this time the line hasn't got back to the oversold zone. I call this an emergence. The K line has dipped a little below 70 and then popped back into the zone. We'll read this as a buy signal. At the end of the day, we've done 10 deals with the British pound and we've suffered 2 losses. The grand total is 452 points of profit. At the same time, the overall price move from the 23rd of October to the 13th of November 2002, that is for 15 trading days, was only 368 points. To be fair, I should point out that this example was picked especially to illustrate the properties of the stochastic oscillator as a trend indicator. Like all the indicators we reviewed today, stochastics reflects only those events that have occurred in the past. Only lines and levels of support and resistance have the ability to forecast. A broken resistance line can become a support line in the future, and a broken trend line predicts possible price reversal. Let's get back to the last example. On the 23rd of October 2002, price reached the support level and the channel line. Later breakouts of resistance lines occurred. Further hourly chart support lines or correction levels allow us to place well-founded stop losses. Let's look at the chart once again so you can take informed and calculated risks, that is, with a stop loss well placed. Well, it's amazing how many opportunities spring from the use of just one oscillator. At the end of this story about the stochastic oscillator, I'll summarize the key points. This indicator generates significant signals around the levels and lines of support and resistance. This means we have to take the boundaries and direction of the price channel plus the position of the correction levels into consideration. Keep an eye out for divergence, the most important feature of the oscillator, and also the combination of candlesticks. If you don't know what I'm talking about here, you will do after watching another of our films. And don't forget about the fundamentals, the news. Make it work for you. Earlier on, we examined price oscillator, a trend indicator which is plotted as the difference between two moving averages. Gerald Apple designed an oscillator on similar lines which has several distinguishing features. Its full name is Moving Average Convergence Divergence, or MACD. The author gave quite rigid parameters for the exponential moving averages which lie at the base of this oscillator. Here, take a look at this. The first part of MACD is the difference between two exponential moving averages for 12 and 26 periods. It's drawn as a solid line. We'll call this the fast line or the main line. And the second part is an exponential moving average of this difference for 9 periods. It's drawn as a dotted line on the chart and it's called the signal line. Of course we can experiment with the time period, but please note the selection of the time periods depends on the time scale of the price chart. For hourly charts, the values of N1 equals 6, N2 equals 24 and N3 equals 3 can be applied as proposed by Benjamin Safin. For daily charts, in addition to the previously mentioned values, the values 9, 19 and 9 can be used as per the famous trader Di Napoli's recommendation. For daily charts, N2 is around a month, 19 or 26. For hourly charts it's 24. Parameter N1 is between a quarter and a half of N2. The parameter N3 signal line is selected from a range from 3 to 9. It seems we've said everything about MACD, how it's plotted and how to select the time parameters, but we've said nothing about what it's for. Don't we already have price oscillator and Ravi? Let's look at the last chart. Our indicator is based on the difference between two exponential moving averages, but the time period of the slowing moving average, if compared to price oscillator, is much smaller at 19, and for the faster moving average we've chosen a time period that is half as long as the slow moving average. We want to trace the dynamics of price change with the help of MACD, and by averaging the difference received we'll try and get trading signals to enter the market. The crossovers give the signals. Look at the points where the solid fast line crosses below the slow dotted line. That's a sell signal. And if it crosses above the slow line, it's a signal to go long. But before we examine the trading signals of MACD, let me run through some of the properties of this oscillator. When the baseline is above 0 and higher than the signal line, or when it's below 0 and lower than the signal line, we can assert that it's highly probable that the price is rising or falling. We've already seen this approach with price oscillator. It's interesting to know how much of a chart would be shaded as reliable information. It may surprise you to learn that on daily charts of the major currency pairs, more than 60% of the time will be shaded. For almost 2/3 of the time we have quite reliable information on the market direction. And it's about 50% for hourly charts. As you can see, the theory that the reliability of the information rises as the time period increases is confirmed again. We should note that we've examined MACD with Di Napoli's parameters 9, 19 and 9. On a rising market, each oscillator high may become a possible point of reversal. Immediately after such peaks, unshaded areas appear on the chart. They often predict a divergence, something we should be very familiar with by now. we've got a double top or double peak on the price charts and two falling highs on the indicator chart. So what can we do with the sell signal? It's evidently too early. We already know that answer. Only support lines and levels can confirm if the trend is over yet or not. Until there is a breakout, we needn't be in a hurry to remove such a pleasant colour or to leave such a profitable trend. It would be great to know in advance where the resistance level is which the price will reverse from. But is this possible? It's not only possible, it can be done pretty often. But we go into that in our film on wave analysis. At the bottom of the market, a divergence looks like the mirror image of the price chart above. Here it is. Double falling troughs or a double bottom on the price chart and two rising troughs on the MACD chart. We'll draw our lines and levels again, but this time they'll be resistance lines. And again, we won't buy till the price chart tips us the wink. Practice makes perfect. And let's repeat once more that there are some things that will help us identify reversals on a price chart and consequently confirm the signals of MACD. They are the signals of Japanese candlesticks, fundamental news, support lines and trend lines, and the oscillators we've already reviewed, RSI and stochastic. But up to now we've only talked about trending markets. What happens when we are in a trading range? We've already seen similar examples. How can MACD help us here? Remember the alligator? It's based on exponential moving averages too. The jaws close and moving averages twist against each other. Surprisingly, a daily MACD can be more of a hindrance than a help. Its signals lag and we could buy when it's time to sell. So, we examined this situation thoroughly in terms of hours, not forgetting to use the borders of the range from the daily chart. We plot MACD with parameters 6, 24 and 3 following Safin's suggestion. Along with support and resistance lines and levels, we include RSI and stochastic. And I should repeat everything I said about trending markets as well, word for word. Now, let's get back to our battle again. Well, maybe I was getting a bit carried away when I was talking about a battle. What we study here is not how to battle the market, but how to go with its flow. And that's half the battle. To wrap up the MACD, especially for those who are too lazy to examine the space between the main and the signal lines, I'm going to tell you about an indicator known as the MACD histogram. It plots the difference between the main line and the signal line, and it appears on the chart as a series of columns. When the baseline is above the signal line, this indicator is greater than 0. And when the baseline is below the signal line, the indicator is less than 0. When MACD histogram crosses the 0 line, it's MACD's trading signal. Look at the chart. We've examined quite a large number of indicators that are used in technical analysis in the short term. How can we remember them all? And what if I told you that there were several hundred indicators? Would you be afraid? Very afraid? Hey, don't worry. It's not as bad as it sounds. First off, most of the indicators that you don't know are modified from the indicators you already know. Second, not more than 3 or 4 indicators are used in one trading system, and we'll go into trading systems in another film. Third, you should never believe that there's a magical indicator that can help you win all the time, or that there's a set of parameters that can precisely reflect the dynamics of price change. don't waste your time searching for a holy grail. It's not difficult to trade on the exchange. The simple set of indicators we've reviewed using our recommended or slightly adjusted time parameters, along with common sense and strict discipline, are all you need to select the most significant signals that confirm each other on the direction of the market. Remember what Rodin said, you should simply remove the excess stone to be left with a beautiful sculpture. It's that simple.